Technology stocks have done well this year in the UK and for that matter worldwide, and it's easy to see why. A good tech stock can generate growth almost whatever the economic conditions if it has a killer product, first mover advantage, a powerful market share, or indeed all three. Such earnings growth is likely to be highly prized at a time when the global economy remains for choice pretty sluggish. So you may therefore be perplexed to see ARM fall after strong second quarter figures this morning and Apple suffer an aftermarket slide in the States last night, even though it published bumper Q3 numbers. Hello, I'm Russ Mould, AJ Bell's Investment Director, and I'd like to quickly run you through today's tech stock events. First, ARM. The FTSE 100 firm shares are down around 4% at the opening to just below the £10 mark, and that compares to a year high north of 12 quid. And all despite good Q2 figures this morning. Sales were up 15%, pre-tax profit was up 32%, and the interim dividend was up by a quarter. Now the firm signed a record number of processor licensing deals and booked royalties on 3.4 billion electronic devices that were shipped featuring its architectures. Yet the shares were still down. Why? Well, there are concerns over growth in the Chinese smartphone market. A number of global chip stocks have issued profit warnings, notably Fairchild and Micron in America, and Apple did fall after its numbers overnight, possibly dampening sentiment. That may be enough to persuade some investors. A valuation of 30 times earnings for this year and 28 times for next is enough for now, even if new iPhone launches using 64-bit technology should give a strong boost to royalty income in 2016. As ever with ARM, it's a matter of balancing the valuation with short-term news flow and the company's strong competitive position and long-term potential. As for Apple, it's a brilliant example of market psychology. The shares had run up very strongly going into the Q3s, which were in the end excellent, beating consensus estimates. Sales rose 33%, earnings per share rose 45% to $1.85. Again, though, the stock went down. The reasons here? Well, forecasts had risen very sharply going into the figures, and as a result, Apple only just topped the consensus of $1.81. That may have been enough to tempt some profit takers. Classic, buy on the rumour, sell on the fact, I guess. Again, now it's a matter for investors to judge valuation against long-term earnings and cash flow potential. Thank you very much for watching, and I look forward to seeing you next time.